Good day, fellow investors. How much cash to have today? Is it a hedge? Is it losing value? That is a very common question I get. And especially as we are reviewing portfolios like we did retirement portfolios last week, this week we're going to look at portfolios with a high cash exposure. This is Gear with 64% in cash, Loki with 40%. Here we have Kurt that's thinking about going into cash. And here we have an old guy, Warren, that's also highly in cash, 30%. If you look at his equity without liabilities, you could say he's also 50% in cash. Personally, I'm fully invested and I see opportunities, so I invest everything. Model portfolio that manages diversification a little bit more because it's representative of my research platform is now 12% in cash, as I have, let's say, lowered my China exposure on this bull run. Nevertheless, we'll discuss cash. The yield now is getting lower with lower interest rates. If you're in cash, you expect stocks to crash. That's also something. But then, how much cash to have is another question that I often get. Is it working as a hedge? And we'll go through the portfolios to see what is the risk and reward, but also the temporary perspective on cash. Now, not a bad idea, but cash now for 7 years might be a very bad idea. Let's start discussing yield. If I look at Interactive Brokers, if you want to support the channel, if you click on the link in the description below, I get a few bucks for the click. You might check Interactive Brokers, which is a good global broker, helps you invest cheap across many markets, and also you get a good yield on your money, especially if you have a little bit more money, in line with a little bit less than the yield on the US Treasury. As that is going down, so is also Warren Buffett's cash flow from bonds going down, but it's much better than where it was just a few years ago at 0 when you were getting nothing for it. It was better here at about 5%, now it's a little bit down, but still something. However, 3.9 compared to inflation, real numbers will likely be 4%, this is government measured. So again, you're getting 0 in real terms, but at least not negative. At least it keeps your purchasing power stable. At least it should, and at least for now. So when you look at that, is it better to be invested for a real return than to get 0 real returns when you adjust for inflation now? Well, yes, it's better to be invested in good businesses with a higher real return, but the key question is, and the reason likely most are now in cash is because they expect a crash. And the key question therefore is, will stocks crash? If you look at the S&P 500, this is ridiculous. So we are more than a 3x over the last decade. So this is one of the best stock market performances in history, more than a 3x. And I've started sharing my financial analysis here 10 years ago, seeking alpha since 2015. I found this article exactly 10 years ago where I looked at the S&P 500. I thought it was overvalued and therefore I needed to find two better investments there. And you can see my conclusion or the article. I said the S&P 500 is overvalued. Crazy as it might sound now compared to what has happened in the last 10 years. However, you see here 3x, even if many thought that already here it was overvalued, and now it is much more overvalued, but nothing prevents it to make another 2x. And if you have been sitting in cash here, you have been getting nothing for a while. If we look at valuations, October it was 23 compared to the historical P ratio, significantly overvalued. And if we look at earnings, current earnings, we put the 2015 P ratio, the S&P 500 would be below 5,000 points. However, even then in 2015, everyone was saying there is a recession ahead, high P ratios, nothing looked great, high debt levels. the same stories as now. And still, this is what happened, and compared to those invested in cash back then, most of the time they were getting zero and just a bump here the last few years, but practically maybe on average 1%. 1% compared to the 15% of the S&P 500. Just for reference, this is the portfolio I researched back then, and I have analyzed a little bit what happened to those stocks. On average, those stocks that I selected there did a 3x, so 3x, 3.5x for the S&P 500. I still did well, but in my defense, the goal was to get a long term around 9% with 3% dividends for 10-12%, and that has been achieved. Even better. That is value investing. So even here, with just limiting to S&P 500, it has worked. Of course, I'm not limited to the S&P 500. Check my performance video where I did my 15% since 2018 per year, of course. So the market was supposed to crash in 2015. It was up 3x from 2007. The results are the S&P 500 is 3.5x, bonds are almost at zero, negative real return over a decade, and Sven Carlin, idiot portfolio back then, still doing okay, free, limited to S&P 500. If that happens again, then you are again losing for a decade and losing big. Warren Buffett has been losing big on his cash exposure the last decade, because if he had bought more Apple, now Berkshire would have 500 billion more. That's the deal. That's 50% of Berkshire. That's a huge loss. But then again, the question is, will the markets crash now? Because the P ratio is 31, and historically it has been higher just during the dot-com bubble. All these bubbles here were not as expensive as we are now. If we look at the deficits and the government debt, interest payments are starting to bite. That is to GDP is really growing fast. 2015 was still below 80%. We are now at 100 and going to 120 fast. Earnings per share, okay, not growing stellarly, but still here 2x over 10 years, 7%. And now we have even bubbles all over. We've discussed the AI bubble recently, so everyone is investing, vendor financing. NVIDIA is giving money to customers to give it back to NVIDIA, things like that. Really big pyramid. So that is the environment. Then we have crypto, gold, private equity bubbles, really something that can have huge systemic risks on the system, alongside government debt. So we can't know whether the markets will crash. Given the situation, it's likely everything will crash. The thing is, one day, and nobody knows when. Warren Buffett went to cash, and he is therefore predicting a crash. If not, he would not go to cash. But that's the deal you have to make with yourself. If there is no crash, I made my money already in the last decade. That's something that people tend to forget. We all made great returns in the last 15 years. When is enough might also be a perspective. Therefore, you go to cash, thank you, hasta la vista, enjoy life. But on the other hand, another question, will your cash be worth anything when the crash actually happens? If we look at what's going on with purchasing power, it's getting destroyed. And you can see here, big crashes in the value of the dollar. And here it might look like it is stable, but still it is down 50% over the last 25 years. Here is 100 at 2000, 58 at 22, given deflation. We are now at 50. So that's 50% purchasing power down in 25 years. I think 50% purchasing power down, given the situation, will happen again in the next 10 years. By holding cash, you are sure to lose, especially if there is no crash. So if there is no crash in the next 10 years, and they print money and everything, and stocks start going higher because everyone knows they will print, then you might lose 50% with cash. That's something spectacular, but can happen. And the forces are that is also something that can happen. So when it comes to cash, then, okay, Sven, cash there is risks, how much is an optimal exposure? First, you must have enough personal cash for your life that's always separate to whatever we are talking here when it comes to investing. Your life standard, whatever happens with the markets, should be covered. Then you can rationally think about investing. If your life quality and life standard, way of living, is under the influence of the market, if the market crashes and everything, your life standard crashes, then you're in trouble. That's a given. So you have to think about that first. Then you can look about optimal cash portfolio allocation. As always, if you need the money in the next 5 to 10 years, don't invest. Keep it in cash, and if it goes 50% lower, well, at least you have peace of mind. Sometimes you win, like we did in the last 15 years. Sometimes you lose something. That's money and investing. Now, what are the alternatives? I always say my strategy exposure is having good businesses that have a good yield, good P/E ratios, defensive stocks that will over time lead to higher levels of wealth no matter what happens. Here I've discussed 6% yield, 5% growth that I can reinvest, food stock, so you might also check that video for more information. The situation is, if you have 350 billion, the alternatives are high. My personal portfolio position is 1.2 billion market cap. For Warren, it wouldn't move the needle. But if you have other opportunities, you might invest in other opportunities. Now, as we discussed also in the retirement portfolio reviews here, a lot of you are looking for hedges, and cash can be a hedge. But then again, if nothing happens, keep in mind this is insurance, thus you are losing, even with hedge, even with puts. And as I said, if your lifestyle cannot survive 50% crashes, you either are in cash or use options, put options to protect from the decline. How to use put options? As I said, I'm not doing it. My strategy is owning businesses that will also protect me in case of a crash. That's something specific. However, if not, go to ChatGPT or another AI tool. Learn how to use those put options, how to best structure those with minimal cost for portfolio protection. You need to spend the day and then you need to do it weekly to watch it, how it goes and everything. That's an important job. But if you have a few million and are retired, it might be something to do. So let's look at the portfolios and discuss a little bit more on the risk and reward of the situation. Here we have Gear. He is 64% in cash, plus 14, plus gold, plus Bitcoin. Okay, the cash is yielding 5% for now. So we could say he is really defensive, waiting for a crash. There are free ETFs here, I think, so nothing to mention. Now, what happens here? If the market keeps on going, if they start printing money, if this and that, then this is a sure loss of purchasing power. If the market crashes, great, or maybe not, because Gear is here in cash waiting for a crash. However, if you're afraid now, when the economy is doing good, when employment is looking okay, everything looks great, what makes you think you're going to buy if there is a 50% crash? A recession will look like the end of the world. 20% unemployment, everything will be ugly, and the Fed will print money, hyperinflation, stagflation. What will make you buy then? But you have already lost 50% of purchasing power because the Fed is going to print. So that's again a question. Okay, what is the driver of my wealth? The driver of your wealth should be business fundamentals over the long term. If you're betting on the market crashing or something like that, then the driver of your wealth is bets. Bets sometimes work, sometimes they don't, and anything can happen. So that is something that people forget when it comes to allocation. Cash is not a safe haven. For now, Gear has no purchasing power loss. He's stable at 5%, but he's running risks, and perhaps a little bit more diversification here would be better, up to a personal limit, a personal feel-good situation. But 30%, 30, 40% in good businesses that will do well no matter what, that also yield 5, 6, 7%, that you can then reinvest is also something perhaps to consider. Then we have Loki here is 40% in cash because he sold already a lot of positions, and he is looking here at his Bitcoin, his Forex. He put 2% of his portfolio now, his 5x there. Some Google, some Amazon, some smart centers. He's always here mentioning the entry price. That is called mental accounting and anchoring. What happened in the past doesn't really matter with your portfolio, because then you're anchoring to what happened back then. You have to see, okay, would I buy it now at that price? He wouldn't, but why are you still holding? These are the eternal, let's say, questions of finance. You reduce a position, but you would not buy it, but holding is the same as buying. So that's something that you have to see when it comes to managing your portfolio. So if I remove mental accounting, this is the portfolio, and Loki here says I can be 40%, 50% down due to tech and crypto exposure, but Loki is still 28. Now, my key concern here is here with this price doesn't matter at all. So what are the return drivers of your investing strategy? That stocks go up in general. But when ugly, will you buy more? Because when ugly, everyone will think that the markets will crash forever. So this is not fundamental, and the markets, when they crash, it gets uglier and uglier. So my comment on this portfolio, first, cash, okay, he's waiting for a crash to balance his portfolio, but the driver of returns is not fundamentals, it's just the stock market. So no real advantage and no real certainty for when it gets ugly and uglier. Comment from Kurt here, member of my platform. He is up more than 40% this year, started investing 3 years ago, compounding nice, dividends are coming in. So how to define what to sell to take risk off the table? Is a 10% cash cushion enough? Again, this is the key question. How much to sell, how to manage that? And then 57 pension fund, so there is safety, and that's for additional income, another 7 years, and keep nest egg compounding and growing until the unfortunate bitter end. However, also potential multi-generational wealth basis. Now, when it comes to selling something and going into cash, I recently sold two of my 3 Chinese positions because 2x, okay, money made, the risk and reward simply didn't fit my strategy. I like low risk, good fundamental returns. The fundamentals improved a little bit, but not enough to justify the 2x. Maybe it can go again, but I'm looking for fundamental driver of returns, compounding that equity on the basis. That has changed there. The stock is higher, nothing else has changed, thus I sold. And then I bought something else a little bit, lowered the cash exposure from 16 to 12%. So I try to manage that risk. The only thing I can say is you have to see, okay, how is your portfolio when it comes to fundamental returns? That's what I focus on. And then how prices interact there. Is the price increase too exuberant that the fundamentals are not following, so that the price goes up 2x, the risk goes up 2x, and the return halves? If that is the case, you might consider selling. But you also have to see, okay, what are the alternatives? Cash, we know that in 10 years it will be ugly. Waiting for some sectors, for this, for that. If you have a global perspective, sooner or later something will fall into our bucket. And then we have Warren. He's 95 years of age. He sent in this portfolio, really nicely structured and everything. This is the most beautiful portfolio I got into my emails. He said 30% in cash compared to assets, 50% in cash compared to shareholder equity. He said that practically he can do whatever he wants with the cash, 350 billion, because the assets and liabilities are mostly related to themselves. There is no real long-term debt there. The problem, I think, is 350 billion cannot be really deployed. Well, he sold a position, he said it's called Apple, and he said it was too exuberant, buybacks were not creating value anymore, no growth anymore, and that changed. Apple changed from a P ratio of 10 to 40, and then Warren Buffett sold. That's his strategy, and his goal is capital preservation first, and he knows, okay, I'm okay with zero returns in the cash, some yield, and we'll see how he start distributing. Maybe there is now an announcing that he's spending 10 billion, so that's 3% of the cash. That's really not much. However, slowly and steadily, especially if there is a crash, he might buy things. I think he's waiting for the private equity bubble to burst. That is likely to happen, and then we'll see who and what will be bailed out and how. And he knows that risks are piling, so Warren Buffett is predicting a crash. So can the market crash if Warren is saying so? Yes, if Berkshire is saying so. Can it go higher? That can also happen. So I'm looking at the driver of returns. Warren Buffett cannot deploy so much money for a good return, so he is preferring cash. So hold as much cash as you feel comfortable with for the next few years, but try not to stick to cash, because the longer you hold it, it's not that it's riskier, it's sure that you will lose over time. That is how cash is made. With the government debt situations and everything, it's likely these shocks will be bigger and bigger, inflation and money printing, wait for a recession, and then we will see how it will go. But it's not a safe haven, therefore I would always say cash okay, but keep looking for margin of safety, value investments. You can check my research platforms for some ideas, 21-day money-back guarantee. See if that might fit on your portfolio structuring, a bit more of value investing, and then over time you build that strong, diversified, anti-fragile portfolio that will survive no matter what and create that multi-generational wealth. Thanks for watching. Check what I do. I'll see you in the next video.